is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Today we're here with Sue Zhu to the show. Sue is the managing partner at Amino Capital, a global venture capital firm based in Palo Alto, California that invests from seed through growth stage. Since joining the firm in 2012, Sue has been part of seed and Series A investments that help support the rise of around 20 unicorns and more than 45 companies valued at over $100 million. Amino Capital manages over $1 billion in assets and has backed standout companies including Chime, Webflow, Rippling, Grail, Replete, Turing, and Write/Sonic. Sue brings a unique perspective shaped by her work across venture investing, AI, data-driven platforms, and frontier technology, making her a fantastic guest for today's conversation. Sue, thank you for joining us.
Thank you for having me, Hall. Yeah.
Great. So where are you calling from today?
I'm based at downtown Palo Alto.
Okay, great. So let's start with the founding and vision of Amino Capital. What's the origin story behind it, and what's the current thesis that guides the fund's investment strategy?
Amino, of course, it came from amino acid. So a lot of people said, "Oh, you must be a healthcare fund," which showed that the other party must be like really good. And then in biology, so I was trained as a scientist, and I was a PhD and postdoc at Stanford, and then. So when we first had the fund, and then we really want something that nobody else had it before, because there were so many great funds and good names were taken. And then we were like, nobody got Amino. And then we started to actually tell a story behind Amino Capital that amino is the minimal form of protein, which is the minimal form of life. So that actually resonated with our mission. We wanted to actually invest in our friends, invest in people that used to work for us or people that we used to work at. So it's really about ecosystem, and we wanted to invest in seed and pre-seed.
Great. Let's talk about investing at the intersection of AI, data, and deep tech. How does Amino Capital evaluate emerging technologies such as AI, machine learning, and data infrastructure? What do you look for?
Yeah, I feel like it's right now is very hard now to invest in technological theater. So a lot of things can look impressive in a demo. Much fewer things become enduring businesses. So I think what really actually differentiate Amino from other firm is that we really believe in data mode and network effect. And that's something that we feel like there is a real wedge. And for example, we invest in company that which actually take advantage of next generation technology, but started with a very niche, very defined problem, like with Asian grocery shopping. And back in 2016, there was no pandemic. There was like the e-commerce adoption was still very small. So we invest in this Asian grocery shopping app only live on social media, and then but using the next generation technology of robotics and social media, more like a social e-commerce. And now, especially during pandemic, they enjoy 6% year-over-year growth and now unicorn.
Well, great. Well, let's unpack the data moat for a moment. We always hear that you need a proprietary data to achieve competitive advantage in the AI space. Thin wrappers around the AI models is not going to sustain very long. But tell us more about data moats. What do you look for in a data moat to say that's enough of a moat to invest?
Yeah, data mode is given actually in Silicon Valley. So if you talk to any large company, Magnificent Seven, and then people always talk about data mode. And then it's funny that you mentioned there's a lot of rappers these days because when somebody showed us a demo, it's not their capability, it was the capability of large language model. And then how do you actually differentiate a real sustainable rapper? Because right now, if you invest, so right now, like people invest in this, deadly bow belt, right? So there is no pie of SaaS anymore. That in the US, people are so proud of the SaaS pie before, but now we invest in like barbell, right? So either you're in the infrastructure layer or you're in the application layer. So there's no doubt all application layers are quote unquote wrapper, but if there is a wrapper, who actually can have projected 1 billion revenue and paying Anthropic a couple hundred million. It's a sustainable business. But there are other type of rapper, they magically show really good demo, but once they actually post that linking, they have like maybe 200 million revenue, but they have to pay OpenAI and Anthropic collectively probably like 400 million. And then this wrapper is not sustainable. So what's the difference between these two type of wrapper? I feel like it's all about workflow. Yeah. Do you really own the workflow of your users? And do you really replace labor of your users?
Ah, that's a good point. So, what are the key signals Amino Capital looks for when evaluating founders in early stage companies? I mean, some of these companies are very early and not everything is known and the world is changing, but what are the signals you're looking for?
Yeah, I feel like the number one, early stage seed, pre-seed, we always look for the team, like founder market fit, and why is this founder uniquely positioned to solve this problem? But underlying, we actually look for resilience. So you probably got asked millions of times why a startup fail. Oftentimes we say the startup failed because they ran out of money, which actually not true. In terms of all the companies that the 20 unicorns, because they always have this certain point in their lifetime that they about to run out of money. So some of them, they even have to, put on their house for refinancing and put those money in the company, right? So they almost ran out of money. But those resilience actually come from their educated bet. So they were the one that actually at the front line talking with their customer. So they knew they just have to change a little bit of something, and then their customer need them. They will take off. So we're looking for that kind of resilience. We're looking for founders who love their investor, who love their users. So many times we have talked to founders who said, oh, my passion is about building the product. I just need to hire a marketing guy. I just need to hire a finance guy who help me to talk to investor, who help me with customer go to market. That's not going to be the founder that will bet.
Well, great. Well, we saw in the early days of AI that it was about applications and then it moved to agents. And well, where's the next opportunity going to emerge?
We feel like AI investing has gone through several very distinct phases. I mean, phase one is probably infrastructure. We invest in company like the Matrix early. Now they're $2 billion company and they're trying to compete with Croc, NVIDIA now, and inferencing. So better foundation model. You've heard of this type of wave of new kind of like foundation model company called Neo Labs, like companies that actually spin off from, laboratories at Stanford, Harvard, a lot of really good universities and born a $1 billion company. They deserve it because they're building the next generation foundation model. So they need to actually raise like money that actually can go through deep, like a couple of wave, like bubble bursts. So they have to raise tons of money because they're research driven. And then, well, I think that's the phase one infrastructure excitement. So we actually just been through phase two, the co-pilot proliferation. So we saw explosion of AI co-pilots tools that could draft, summarize, search, or assist. And then we actually invested in companies that actually can build a data mode back in the tools kind of like exploration time. And then those company, we invest a lot of company doing very well. They were doing intake for, like medical, for medical caregivers, clinicians, and law firms because they're not touching their customers' internal data. So they just get intakes, right? New data that you otherwise will not get. So those companies doing very well, Copilot. And then we just got into phase three, agentic system and vertical execution. And like open cloud, right? So Copilot is more like a brain and open cloud is more like arms and legs. They can really do things for you. And now we're entering what I think is the more interesting phase. and it owns part of the workflow. And that actually can make this type of a company charge 10 times, 100 times, 10,000 times more than traditional SaaS company.
Absolutely. So, what's your definition of a workflow in the sense that it qualifies for, network effects, data moat, and so forth, that it really will generate the numbers you're talking about? What does the workflow have to do?
Yeah, it actually favors company that understand workflow reliability, human in the loop design, domain specificity, and operational trust. And then how do a 20-year-old get all these type of experiences? Oftentimes very, very hard, right? So, but the thing is, if you don't invest in young people, you don't get to actually have that kind of a high agency. That's why you've seen people that still investing in, Stanford dropout, even high school dropouts, because they're very much high agency, and then they have like two, three co-founders, and they just keep coding 24/7. So you need that kind of high agency. But, as you might ask, how do they get the experiences? The funny thing is, once you start your own company, you will take advantage of all resources that you could take advantage of. Sometimes your parents, sometimes your classmates, sometimes your internship. So you have to actually go out, go back to your life and to really, really have this design thinking, which I felt like a Stanford Design School, they really have really, really good mechanism. I think a lot of the, even high school kids and they are actually reading the book Design Thinking. So I feel like you really, I mean, I give you example like a Hopper. So one of the YC company that we invested in. So they just raised like a couple tens of millions of dollars. And then they were doing insurance brokerage workflow. And then Hopper, the name was after founder's mother because his mother actually willing to actually give him the workflow and then actually lead him go through the whole process of selling a commercial insurance.
Right. Well, let's talk about bridging global innovation ecosystems. What are your insights on connecting Silicon Valley innovation with global startup ecosystems and markets? How do we do that?
Yeah, I feel like one of the biggest mistake in venture now is assuming innovation is geographically linear and that it starts in one place and simply spread outward. And in reality, I feel like Silicon Valley now innovation today is much more distributed, but not evenly distributed. So I feel like different regions have different strengths. I think Silicon Valley is still the hotbed of a lot of the innovation and founder density, capital formation, technical ambition, and category creation. And then I feel like Asia is incredibly strong in speed. They very good at copying, right? And manufacturing and commercialization because it's a really well-defined, unified market. So and the market responsiveness because people there work already 24/7 for the last 30 years. So application layer, we're kind of like sometimes we rely on the engineering management from the Asian market. And Europe often excel in research and industrial system and you know, technical rigor. So, and talents. We invest a lot of people that from UK. But what's funny is if you ask them, do you want to start a company in UK? And they say, no, I want to start a company now. And once we give them money, their first customers sometimes are from UK. So yeah.
So let's talk about technical founders. What are some best practices for working with tech founders, who are building deep technology startups? Deep tech is a little bit different now because we're at the law of physics and so forth, but what do you see there?
Yeah, so that's really, really interesting question because I feel like in Silicon Valley, we often do not, restrict us into something called deep tech because Silicon Valley always say hardware is hard, but if you go out to Boston and then go to Caltech and deep tech is huge, right? So I think the one of the most important thing investor we can do with technical co-founder is not oversimplify what they are building. So a lot of great deep tech founders are solving, genuine hard problems, which can be the bottleneck for AI. So AI has kind of like a glass ceiling, right? So hardware is a ceiling, energy is ceiling, and data is ceiling. There is a lot of ceilings. If you force them too early into a shallow startup scrape, and then I think we can actually distort the company. So our job is not to de-technicalize them. Our job is to help them translate technical truths into business momentum. And then that's why we felt like we really wanted to go to the laboratory at Stanford Caltech and we talked to the professor. And then I used to work at Stanford Hospital. So we really wanted to help them communicate clearly what they're trying to build to customers, to hires, to investors, and eventually to the market.
Well, great. Well, so let's talk about, working with durable venture portfolios in rapidly changing markets. What are the strategies do you use to manage risk while backing these transformative technologies? Because there's quite a bit of risk in deep tech.
Yeah, so I love deep tech. My research was actually on stem cell. And then I think in venture, we don't manage risk by avoiding boldness. If we actually invest in certainty, and then my investor won't be happy, right? So we wanted to invest and we wanted to manage risk by being selectively bold and then to go back to our first principle, which is the data mode and also the network effect. I think the biggest mistake is to think diversification alone creates safety. So I think in early stage venture, durability comes more from quality of judgment than quantity of bets. So for us, we really build this first principle and we stick to it. So we look for a symmetry and we love opportunity where the downside is bounded, but the upside is more like a characterized defining. So that's why we wanted to invest the best in the whole world. I think it's very, very easy to find those laboratory. And then I think we started to build a really, really good relationship with a lot of professors at Stanford, Berkeley, and MIT, Caltech from day one. So that's why they got me because I was trained as a scientist and I love science. And then also we kind of wanted to we kind of care deeply about adaptability. So the market changes, right? And models change, and even costs change, distribution change. So we ask, can this team survive multiple market regimes? So I feel like a lot of the really good founders, like laboratory spin-offs, they already have really continuous, they got their professors on board. They got their professors on board and they have endless resources from their laboratory. And then also not just the team, but also they actually have early communication with DOE, DOD, and a lot of the grant writing partners. And then there was like one of my portfolio company about energy and also battery. They even introduced us to another fund who helped them to get the grants. So there are so many people that they have to, so we have to invest in people that we truly respect and not just we give them opportunity. Once they get the money after 18 months, they have the next milestone, other people, they will respect them. So you really have to be the best in the whole world in deep tech.
So what distinguishes startups that successfully scales from those that struggle with scaling?
I feel like, yeah, so the difference is usually not raw intelligence. And most the founders we meet are super smart, the best in the whole world. The difference of is often like clarity and often resilience and often the ability to compound trust. I feel like you really have to understand compounding law. So that's very important. Not just we as early investor, we care about it, but also growth stage investor, they care about it. And even the public market investor, hedge fund, they care about compounding. So the company that can scale very well usually do a few things. exceptionally well. So number one, they stay close to reality. They don't confuse investor excitement with customer truths. So basically, they actually give us really, really good data, very clean data, and then to the point. So they actually give us monthly data. That's why we develop our own to deal with, to crunch those data. We develop our own data-driven investment agent platform. So basically, if you just give me a data, I generate a due diligence for you. It's very much structured data. And then from those data, we can actually tackle our kind of like a Fortune 500 and recruiting business development pool, and we can make connection very easily. So number two, they earn trust early. So because they give us data and then those data actually, especially in deep tech, right? So I think the customers are not just buying features and they're buying reliability. So I feel like the company that can scale in deep tech are the ones that become trusted enough to handle increasingly important work. I gave you an example, like one of the deep tech company. So their investor is a corporate, large corporation conglomerate from Japan. So they actually build a platform. They openly talk about the challenges and opportunities, and they invited that investor to actually join the roundtable and everything. They have meetings with NVIDIA, with the top, tech giants in here. So I think they really gain trust of that Japanese conglomerate. And then they actually not just give them business, but they became the eyes and ears of this Japanese conglomerate. And later on, the CFO of the Japanese company dealing with this became CEO. So you can see that kind of relationship will go a long way. So yeah, so I feel like founders they also need to evolve, and then so they have to delegate, and then thanks to agentic AI, and now they really can actually subscribe. I met founders who every week, every month, they write off bills for all these agent companies, like maybe 100 of them. So it's already happening.
Well, great. So, how's AI changing the way venture capital firms source and evaluate deals? Where do you see it impacting?
Yeah, that's a really, really exciting question. Especially, I mentioned a little bit that at Amino, we actually created our own ARM system. So it actually help us to help GP to generate due diligence reports with just a single email, and then structured data. You can give a score, and then you, especially when there is like a YC demo day or a Stanford demo day or any demo day, you have like hundreds of company, and then each GP can use the score to actually sort companies. And then it really saves us a lot of money, right? So another thing is we also have LP real-time reporting system. And that is a crazy. Like my investors, they can see the TVPI, DPI real time. They can also see some of our companies. They actually wanted to get certain type of connections, or they're looking for certain partners, and then they can have better discovery of how they help the portfolio companies. So normally they get this type of communication during the annual conferences, like everybody under one roof in person, but because our real-time reporting, and then we can actually mitigate this. And then we also have founder space, so we can better support portfolios in terms of recruiting, go-to-market support, finding next round financing. So it's really more like a VC operating system that we're building here.
Well, great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
Thank you for that question. I feel like even though I still feel I'm early, like I'm learning every day, but I've been in this industry for 13 years. So I feel like the first thing I would say is I think don't confuse access with edge. Just because you can see deals doesn't mean you know how to underwrite them. And then I think for new investors, it's really, really important to get to your own fundamental. What's your first principle? What kind of investors you are? And then I think we really need to build our own pattern recognition honestly, something that we actually can tell entrepreneur, can tell everybody the same story, like Amino, data mode and network effect. It really suits us well. So, and then also suits our persona, like our partner joined Google very early and, Meta very early or investing in Zoom as first money. So people trust us when we say these things. I think that's very important. Another thing is, I think we wanted to be humble but decisive. I think early stage investing require conviction under uncertainty. And then we oftentimes will be wrong, right? So the goal is not to be perfect, but we have to have a system. Yeah, we have to be right enough on the outliers. So I think if you just, you don't have a system, you don't digitalize what you do, just out of your mind, and then you make mistakes, and then you don't have a system. So that's why I highly recommend everybody to build their own digitalized agentic system. Yeah.
So, how best for listeners to get back in touch with you?
Yeah, Sue at aminocapital.com. Either you're looking for investors or you're looking for GPs or you're looking for jobs. And then I have a whole ecosystem for you.
Great. Well, I want to thank you for joining us today, and we hope to have you back for a follow-up soon.
Thank you, Hao.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.